Great, we'll go ahead and start. Hello and welcome to a new Advisors Webinars Education Series. Thank you for joining us this morning. My name is Liz Notling and I serve as the Vice President of Operations here at New Advisors. Today's session is open for business. It's a market update now that the U.S. government is back open. Nick Schneider will be leading the presentation, but before we get started, I do have a few housekeeping notes. Today's webinar is being recorded. If you have questions, you can at any time ask in the Q&A at the bottom. Otherwise, at the end of the call, we will leave some time for Q&A. Brief disclosure. The information shared today is intended for general education purposes. It provides an overview of a New Advisors, our services, and our approach. It is not individualized investment advice. We do that best when we have the chance to understand you and your unique circumstances. Before I hand things over to Nick, I just want to give you a little bit more about who we are, what our mission and vision and values are, who the team is, and who we've worked with previously and currently. One of the biggest foundations that we have is through education, such as today. Hopefully, it's the reason why we hope these sessions. We are committed to keeping our clients informed. With that, let's go ahead and get started. And Nick, I'll turn it over to you.
Yep, thank you, Liz. You can hop over right into that first screen here. We always like to start these with like major themes we're seeing in the media because there always seems to be some level of fear, whether you turn on like Fox, CNN, MSNBC, or I guess just MSN or NBC now. All of them are throwing out headlines at any given moment because we know that fear drives the most clicks, gets the most engagement from all these different news sites. And so these are just some of the headlines that we've gotten. Why markets are on edge, Nvidia doing well but still scaring the market, inflation. And then the bottom here is the fear and greed index. And so what you're seeing here right now is even though like, yep, markets came down off their all-time highs that we saw a couple weeks ago, we're operating in an environment of extreme fear from consumers. But reality is, and Liz on the next slide, that they're trying to create fear to generate clicks, engagement. This is the reality. This is a screen that we use when we're doing research on where we think the economy and in turn part of the market, because they do talk to each other, are going to be over the next 6, 12, 18 months. And so this is kind of looking under the hood at what we look at a little bit. And this is our recession watch report. We use a company called NDR to help us with a lot of our research. You can look them up, big research company in our world. But they put together this recession report based on key indicators of where they think we are in a market cycle and how likely we are to be in a recession. And so these are your 10 indicators. And then in the top right corner, we track how many of these are trending in those red bars, right? That's what we don't want to see. And right now, there is exactly zero indicators pointing towards any sort of major recession. Can we get pullbacks in the market? Yes. Are there going to be down days? Yes. Volatility, of course. But none of that really means that there is going to be any sort of recession pressures from the economy to go ahead and affect the market. And so this is something we look at to help us gauge that. And it helps to get rid of some of that fear because no matter what the media tells you, when you start to look at these indicators, none of them are pointing to a prolonged downturn, just short-term volatility. Next slide, Liz. So when we talk about the market, we show this slide almost every time on our market updates because this is when people think of the market, right? They want to know what the S&P 500 did, which is the 500 largest companies. And I like this chart because it gives you some perspective because we can put some longer time frames on this going back to 1997. So we've got almost 30 years of market data in this chart. And what I like to illustrate is volatility. We get ups and downs, we get big swings. But if you ride this out over longer periods of time, the market continues to trend forward. Next slide, Liz. And so now this slide is we're looking at the same S&P 500, but what you hear a lot is the market's overvalued. It's something that goes out into the market a lot, and we're going to get into that a little bit between this slide and the next. And what you're seeing here is when we fall in between those top dotted green lines and bottom dotted green lines, we're really in a good average range of where we want these companies' value to be, right? The price of the stock versus their actual earnings. That's what your PE ratio is, price to earnings. And so we look at averages, right? So you're seeing up here in the box the valuation measure of PE. 30-year average is about 17. Latest average is 21. And so that would lead you to believe that some of this is overvalued. But on the next slide, I'm going to talk a little bit about why we don't necessarily believe that. And this is something we've been harping on for a long time. The S&P 500 is really concentrated right now in the top 10 companies, and these are your big tech companies. Think your Facebook, Google, Nvidia, Apple, Microsoft, Broadcom, Tesla. So what you're seeing here on my graph on the left, the average for those top 10 companies is just under 21, and they make up 41.6% of the S&P 500. So when you think of the long-term average of the S&P 500, yes, I understand that it is lower, but when you start to talk about tech, average price to earnings ratios on these tech stocks is typically higher. And so over time, you're going to see that average on the S&P move as long as these weightings remain the same. And that's what you're seeing here. The remaining companies, that blue line on the left-hand side, latest 19.4, the average for those is about 16. And so when you think about what's being overvalued, we're starting to see these price to earnings driven by tech average a little bit higher. So you're going to see this continue to creep up. And so while we're not overly concerned about where earnings are, this is an explanation as to why it's at where it's at, particularly on the S&P 500. And so now here's a little bit broader look, right? This is the different sectors that we see in the market, and these are the returns that we've seen over a couple of major time periods. So now this chart is as of November 21st, and so we're going to focus on a couple of these. So we're going to go over consumer discretionary. This is where a lot of our investment philosophy has been. And so you're seeing quarter to date down 5, year to date down 0.1. And that's in contrast to something like tech. Yeah, we had a little bit of pullback, but tech year to date as a sector up 19.2. And then you're going to see to the right of that these consumers, communication services. A lot of this right now is honestly being driven by Broadcom. And so they've been having a good couple of years, a good run. That sector up on the quarter so far, up 2.3, year to date, up 27. And so, what this illustrates is how much tech is really driving the returns of the index and portfolio. So, if you're not overweight in some of these monster tech companies, you might not look as good on the quarter or on the year. And so that's where we're going to maybe start to see some rotation, right? We've had some big run up on these, so that is something that we're watching because the spread of the weighting in the S&P has really never been greater than what it is right now. And these performances across these companies are what's driving a lot of this return. And so now we're going to talk about volatility. This is one of my favorite charts. I do believe I show this one in pretty much every market update that we do. There are always going to be periods throughout the year where we are down. And so what you're looking at in this chart, you have the red dots and then gray bars. The red dots are the biggest pullback that you had in that year. And so if you look at all the way on the right-hand side in our year-to-date number, the S&P 500 at one point was down 19% back at end of March, early April, currently up 12. The other one I like to show, if we go back to '08, right? At one point down 49%, finished down 38. So there are always going to be pullbacks, and it is possible that sometimes those pullbacks result in down years. But what you're seeing is we were positive in 34 out of 45 years, regardless of that pullback. And so that means that even though there is an average drop at some point in the year of 14%, positive in 34 out of 45 years. And so this is where when we talk about staying the course, being patient, this is a chart that I like to use to kind of explain why, because we're going to have these declines. Next slide, Liz. So now we're going to transition, talk a little bit about the economy. And so this is our general slide that we use to just show growth. And so as you can see, our dotted blue line is our trend line, and then the gray line is the actual growth. And so continuing to move forward. And then on the right-hand side, you guys know us, we talk a lot about consumption of the United States consumer. That's driving 68.2% of this growth of our country is going to continue to be consumption. Next slide. So now unemployment, we're going to start talking about things that are going to play into some of the big fears we've heard recently, which are what is the Fed going to do? What is inflation looking like? What is unemployment? So unemployment, we didn't get numbers because the government was shut down. So now we have our September numbers for wages. And what you're seeing here, this chart is showing the unemployment rate over time versus wage growth. And all the way over on the right-hand side, you see our dots at the end of this chart. That is showing what the current unemployment rate is, and that dotted gray line is our average. So average unemployment rate over the last 50 years is 6.1%. We're sitting at about 4.5 right now. What that means, big picture from the job market, is we've seen some cooling, but the job market isn't, it's not hurting, but it has cooled off. And then it coincides a little bit with wage growth. And so we haven't seen significant inflation in wages or really any other part of the market currently, of the economy currently. So now that we have some of our jobs data, we're starting to formulate what we think the Fed's gonna do, and we're gonna show that in a little bit. Tariffs, one of the big boogeymen when it comes to what people think about with inflation. And so, what this chart shows is the tariff rates, right? So, as of November 21st, we had tariff rates on average of about 15.5%. We saw a peak back in April of about 30. And so this is where we expect the tariffs to level out here for a little while as we see more negotiation happening. But it does appear that they are here to stay. And the reason being is you're going to look at that tariff revenue up in that box. And so we are seeing increased revenues come into the country from these tariffs. And what you're seeing is that tariff revenue on the top line is it's growing, right? From in January, we had 7 billion, February, 7, all the way to August, where there was $30 billion in revenue generated from tariffs. And so then our next slide, we're going to get to inflation. And so now the big fear was that these tariffs were going to cause massive increases in inflation. And we haven't seen major price increases yet above what we would expect to see on average. Average inflation rate over longer periods of time is in this 2 to 3% range. We've harped on it a lot. Inflation in the last 5 years cumulatively has been high, been very scary, up to 30% over the last 5 years. And so we're happy to see it leveling out and getting back to a little bit more normal range. But what you're seeing here, that September 2025 inflation, headline and core, sitting right around 3%. And we're not seeing any particular category get too far out of whack, like what you did when you went back to, say, 2022, when we had our last big market decline, where we had massive inflation when it came to energy and core goods. We saw some of these categories get way out of whack, and we're not seeing that right now. So even though there has been tariffs that have been put on, we haven't seen that trickle down to the effect that some people feared that it could have. So inflation right now, and we keep monitoring it, that doesn't mean it won't in the future, but as of right now, inflation's sitting about where on average you would see it. And so what does that mean for the Fed? Um, Before the new data came out, there was some fear that the Fed might not drop rates again. Now, with a little bit of a cooling job market, they're back on to believing there's going to be another rate cut in December, or at least there will be pressure to do so. Err on the side of caution. Powell is also likely going to be out as the Fed chair soon. And so we are thinking more towards another rate cut in December. And what this is showing is the estimates of where we expect it to be. And so when you look at market expectations, that's our green dot, really expecting another rate cut and then potentially rates coming back up sometime in 2026, 2027. But otherwise, we expect it to keep moving down towards that 3.5% range over the next year to 18 months. Obviously, we're going to need a lot more data before we say for sure, right? And we got to wait for the Fed. But we do expect rates to come down a little bit more yet. And so, lastly, this is just a new chart I saw that popped up. Just the power of compounding and staying in the market. With this fear, what we see a lot is we get clients that, might want to move to cash. And part of our job is to get people to stay the course. We have a plan. And this is why sticking to that plan matters. So this chart goes back to 1995 and shows what would have happened if you invested $10,000 adjusted for inflation. What you see here is if you were primarily in cash, you've lost money. Inflation has eaten away about $1,000 of that 10,000 that you would have invested. Where if you would have been invested in the stock market, large cap, small cap, even bonds, you end up over longer periods of time ahead because you're not getting beaten up by inflation. And so that's where even when you start to get this fear, it's important to understand that when you have longer periods of time to stay invested, stay in the market. And again, this plays into our investment philosophy. Like for those of you that have been with us for a while, we believe a lot in using primarily individual securities. We'll use bonds intermittently. But that last chart illustrates why. Just over longer periods of time, your returns are better when you are in the stock market versus sitting in cash or even bonds as an alternative. Any questions for us? We'll open it up. There's a couple different ways you can do it. You can use the chat, you can raise a hand. Happy to answer any questions. No? Excellent. All right. Next slide, Liz. Again, this is mine and Glenn. If you want to reach out to us directly, you can scan that QR code or our emails. Or if you want to reach out to either your fire or police counterpart, QR codes for each one of these gentlemen, along with their email addresses if you want to reach out to either one of them directly. So thank you everyone for jumping on the call today. Again, always feel free to reach out, answer any questions that you might have.
This concludes our webinar. Thank you very much.